there. As Atlas Tax Advisors, we explain how ISA inheritance tax works for spouses and what the additional allowance may mean in 2026.
Imagine for a moment you're a UK resident, maybe in your 60s. You've worked hard, you've saved diligently over the decades, and now you're sitting down to review your estate plan with your spouse. Now, there's a very common myth out there that when you pass away, your individual savings accounts, your ISAs, they just simply vanish, or they instantly become fully taxable, basically destroying years of your careful tax planning. Well, I'm here to tell you that is fundamentally incorrect. This explainer is prepared by the tax experts at Atlas Tax Advisors, or ATA. They are a premier UK accounting firm that helps businesses and individuals navigate all those complex HMRC regulations. And today, they put together a really comprehensive discussion to help us map out the 2026/27 guide to spousal ISA inheritance.
So it really is the multi-thousand-pound question, isn't it? What actually happens to your ISA when you pass away? Understanding these 2026/27 spousal inheritance rules, it's not just some boring administrative exercise of ticking boxes. It is absolutely critical for protecting your married wealth from the tax man. You know, thousands of couples accidentally get this wrong every single year because they're completely unaware of the nuances. If you misunderstand these rules, or honestly, if you just act a little too early or a little too late during the estate administration process, you could be leaving a tremendous amount of money on the table, permanently losing that tax advantage status. And nobody wants that. Okay, let's dive into ATA's roadmap for today's discussion. We'll be looking at 1. The spousal ISA allowance. 2. Understanding the APS rules. 3. How valuation works. 4. Crucial deadlines to remember. 5. Upcoming 2027 tax changes. And finally, 6. Summary and next steps. Section 1. The spousal ISA allowance. Going beyond the basics of inheritance. We're moving beyond the standard basics of inheritance here, and we're looking specifically at how HMRC regulations handle ISAs between married couples and civil partners. And the absolute core of this is something called the APS, or Additional Permitted Subscription. This was introduced for deaths on or after the 3rd of December 2014, and the APS is essentially a one-off additional ISA allowance granted to a surviving spouse, and it's equal to the exact value of your deceased partner's ISA. This is such a vital mechanism for your long-term financial security. It basically ensures that the tax advantage capital you've built together as a household over your entire lifetime isn't just suddenly exposed to income tax or capital gains tax simply because one partner passes away.
Now, this is a really crucial distinction, and it's a detail many taxpayers first discover only when they're reviewing their tax position during probate. There is a massive difference between inheriting the ISA assets, so the actual cash or the shares, and inheriting the ISA allowance itself. Under the APES rules, you, the surviving spouse, inherit the allowance. Let's look at how this actually works in practice. Imagine your partner wanted to leave, say, £50,000 in cash from their ISA to their favorite charity, or maybe to a grandchild. They can absolutely do that. But the incredible part here is that you still get £50,000 added to your own ISA allowance. You can then fund this inherited allowance using your own personal cash or savings. You get the tax shelter even if the actual physical money went somewhere else entirely.
Section 2. Understanding the APS rules. Stacking your tax-free allowances. First, let's establish our baseline. For the current 2026/27 tax year, the standard annual UK ISA allowance remains at £20,000. That's the maximum you can normally save tax-free each year. Keep that number in mind because it's a strict use it or lose it annual limit for the average taxpayer. And knowing that baseline really sets the stage for just how incredibly powerful these spousal rules are. So the real magic is in how these allowances stack. Let's walk through a practical example for a surviving spouse. Imagine your spouse passes away and leaves ISAs worth £85,000. Well, you still have your own standard annual allowance of £20,000. Because the APS is completely independent of your annual limit, you just add them together. You can contribute your £20,000 allowance plus the £85,000 APS allowance. That gives you a total potential subscription of £105,000 in a single tax year. I mean, it's incredibly rare for HMRC to allow this level of tax sheltering in a single go. That is just an extraordinary opportunity to shelter a really substantial sum of wealth from future taxes forever.
Section 3. How valuation works. The date of death versus the higher value rule.
Let's see how this builds for deaths that occurred after April 2018. When a partner dies, their ISA doesn't just disappear. It actually becomes a continuing account while the estate is being sorted out. And HMRC gives you a choice of 2 valuations for your APS allowance. APS 1 is the value of the ISA at the exact date of death. APS 2 is the value of the ISA when that continuing account is officially closed or when the estate administration is completed. And here's the brilliant part. You get to use whichever value is higher. Look, probate can be an absolute nightmare of paperwork that takes months or even years. Imagine a scenario where you have a 14-month probate process, and during that time, the stock market rallies, causing your late partner's investment portfolio to grow by 10%. You aren't penalized for that delay. You actually capture that higher growth-adjusted value for your allowance. And here is a professional tip straight from the advisors at AMA. Making a single payment into a continuing ISA locks in your APS valuation, so time it carefully. Basically, if you act just a bit too eagerly and make a transfer, or you use any part of the allowance before probate is fully complete, you permanently lock in the valuation at that exact moment. If the stock market continues to rise after you've locked it in, you'll miss out on claiming that extra growth for your allowance. Patience during the probate process is an absolute virtue here.
Section 4. Crucial deadlines to remember. The statutory clock is ticking.
Now, here is the timeline you absolutely must memorize. The clock starts ticking on the date of death. To use your APS allowance by making cash subscriptions, you've got to do so within 3 years of your partner's death or within 180 days from the completion of the administration of the estate, whichever date happens to be later. It's a generous window, but you have to be super vigilant. HMRC is many things, but being flexible with statutory deadlines is rarely one of them. If you miss that absolute final deadline, the allowance is gone forever and there's no appeals process to get it back. Now, what if you want to transfer the actual investments, like the exact shares or mutual funds, directly into your own ISA without selling them to cash first? This is called an in-species transfer, and it's incredibly valuable because it means you completely avoid potentially hefty transaction fees, and you don't spend days or weeks out of the market uninvested while your cash moves around. The steps are simple. 1. You gain beneficial ownership of the assets from the estate. 2. You transfer them directly into your ISA. 3. This specific action must be completed within exact 180 days of beneficial ownership passing to you. This is a very strict 180-day rule specifically for in-specie asset transfers, so you really need to coordinate closely with your broker.
Section 5. Upcoming 2027 tax changes. Why you need to act in the 2026/27 tax year.
Notice the stark difference in limits approaching next year. Right now, in the 2026/27 tax year, the cash ISA limit is £20,000. But starting in April 2027, the government is slashing that cash ISA limit down to just £12,000 for savers under the age of 65. The overall ISA limit remains $20,000, but that remainder is going to have to go into riskier stocks and shares or other ISA types. This incoming restriction makes the current 2026/27 tax year incredibly valuable if you, or perhaps a younger surviving spouse, plan to deploy that inherited APS allowance primarily into cash savings where it's safe from market volatility.
Furthermore, there is a literal seismic shift in estate planning arriving in April 2027. Most unused pension funds and death benefits are going to be brought into the scope of inheritance tax. Think about that. For decades, what was the ultimate undisputed wealth transfer tool in the UK? It was pensions, right? But as pensions lose this massive inheritance tax advantage, protecting your wealth within the ISA wrapper and smoothly passing it to your spouse using the APS becomes your primary and honestly most powerful inheritance tool going forward.
And let's not forget this number, £325,000. That is the standard inheritance tax threshold, the nil rate band, and it has been frozen until 2030. Because of fiscal drag as property and asset values just continue to rise with inflation, more and more ordinary families who never ever considered themselves wealthy are being dragged into paying a punishing 40% tax rate. It's a really significant pain point for taxpayers right now. And this makes utilizing every single penny of your spousal APS allowance more critical today than ever before, just to ensure your spouse is fully provided for.
Did you know? Here is an incredible insight that so many people miss during the administrative chaos of losing a loved one. If your late spouse had ISAs scattered across multiple different providers, so let's say a cash ISA with a high street bank, and maybe a separate stocks ISA with an online investment platform, a completely separate APS allowance exists at each and every one of those providers. They aren't just bundled together automatically. You have to identify and proactively claim them individually from each institution to get your full entitlement.
Section 6, Summary and Next Steps. Securing your wealth effectively.
Okay, so here's what you should take away from this explainer. First, remember you inherit the allowance itself, not just the cash. That means you can fund it yourself, even if the estate's cash was distributed somewhere else. Second, exercise real patience. Wait for probate to fully conclude so you can utilize that higher value rule if the markets have been kind to the portfolio. Third, keep a very close eye on the calendar. Do not miss that 3-year or 180-day post-probate deadline, especially for those in specie transfers. And finally, act decisively before the April 2027 cash ISA limits drastically change the savings landscape for good.
Navigating these regulations, especially while managing the emotional and administrative burden of sorting out an estate, it's really complex, but you absolutely do not have to do it alone. We highly recommend you contact the seasoned experts at Atlas Tax Advisors, ATA, for personalized advice. They can help you map out your individual tax positions safely, ensuring full compliance with HMRC while making sure you are maximizing your tax-free shelters.
I'll leave you with this final thought to consider today. Have you actually calculated the true value of your spouse's ISA allowance yet? Because if you haven't, you might be overlooking one of the most powerful tax-saving opportunities available to you right now. Finally, please note our disclaimer. This explainer provides general guidance only, and viewers should obtain professional advice before making financial decisions. Thank you so much for joining us for this discussion, and here is to making your wealth work brilliantly for you.